Okay, so this week I'm going to start with some opening comments about the sentiment shift about the markets. I'm not so sure it's about the economy. And then I'll cover the markets. I'll look at the past week economic data and then a look into next week. And because I'll be spending some time on next week, don't really have any closing comments that I'm going to add, I guess, to this particular episode. So let's begin by looking at market sentiment. And here we have the AAII Investor Sentiment Survey. And this is probably the biggest eye opener from my perspective, is that we had such a shift from 36.8% the previous week to 24.3% of people being bearish. I mean, that's a drop. And, you look at historical averages, 31% was the average. We've been running well above that for some time. And then all of a sudden, people have become less bearish. And where did they go? They're becoming more bullish. And that's 15% increase, over 15% increase in the bullishness in the markets. And I think most of the people that are on this particular survey are retail investors. And, I don't see the institutional money coming in yet. You'll probably see that when we cover the markets. And, you know, it's really going to be the institutional money that begins to get the volume in that's required to make the markets move forward and get some momentum going. I think we've got a little bit now. And again, I think you'll see it in the markets when we look at those data. And then we look at the fear and greed index, and we were running back in high 50s, low 60s. A week ago, 61, and now we're at 77. So, I saw it at one point today. I think it was 78 was the high. And people are starting to, get involved in it, and also some more of the stocks are. And again, we'll see that in a minute. A lot of these things, we have stream greed and options now around 74. Anything, it's just slightly above 74. 70 is supposed to be the split between bear and bull markets. Anything below 70 is very bullish. The volatility isn't there, so it's neutral. And then, everything else pretty much extreme greed. So, that's a shift. We're seeing some movement. 61 to 77 is quite a move in a week. And so let's take a look at the markets. And we'll start with the Dow Jones. Now, I talked about this last week. These are daily data for the Dow Jones Industrial Average Index. And we've been forming this head and shoulders pattern that I've talked about before. And I believe when we break this, now it doesn't happen every time, but I think it's like the statistics were 60, 65%. You break this line here, about 34 to 80, 296, excuse me, about 34, 300, and then we'll start to see something, they say the measured move could be the same as from the head to where the break is. And I've seen other statistics say it's 1.5 times, sometimes two times. So we can see quite a move up, but you can see it filled out pretty well. We had this candle last week. We had these 5 candles this week. We had a down, and then we're up, and we're up obviously for the week, hitting a lot of really critical levels in some of the indices. So taking a look at SPY, one of the things that it's been trying to do is kind of break this area here between roughly 430 to 432, a little under 432, and we broke through it today, but we didn't hold it, and so we got this kind of doji looking thing where there's a lot of indecision about where it's going, and I think that indecision will be solved pretty quickly next week with the FOMC and Chairman Powell's comments from the Fed. And so we'll see if we can break through this kind of 430, 432 area and then start in new highs. That would be my expectation. I'm still waiting for us to clear this line too. But another thing it could be is a double top. So that's the excitement, I guess, of analysis that you get. Let's take a look at the Qs. And again, it's kind of already broken through. It's having a little bit of trouble getting out of this area, but it moved up so fast that, it's virtually impossible for you to go on a, marathon and then you need to rest every once in a while. I wouldn't be surprised if we work our way back down here at some point, this rising, angle that we have that started back. I don't know what it is. Whoops. Sorry about that. Started back in January. So we've kind of had this thing going up. It's kind of gotten away from it. Expect it to kind of come down or work its way over to where the line is and then maybe work its way back up. That would be not unexpected. The one that I really want to talk about here is the IWM. So, we look at this and this is the Russell. This is a lot of smaller companies. This is when I was talking last week about the lacking of breadth in the market, which we'll take a look at that report here at the end. But we see that we've been in this kind of pennant here, making its way up. And we're at the top of it, so we can expect anything in 5-point range here or so. And when it breaks, it's going to break either up or it's going to break down. My expectation at this point is a break up. We've been in this consolidation zone for so long, since the beginning of March, all the way to now. Finally broke it, and it pretty forcefully, but we're still kind of in this down pennant, down trend. We got a top here that we keep hitting. So we'll see how things happen there. Be interested to see if this is just a bull flag here that maybe is forming at the top of this. There's a variety of things that can happen here, or it might go back down, touch somewhere up in here eventually, and then work its way back up. But it shows that a lot more companies now are participating. You can tell here, one of the things I keep an eye on, other than the price action, is the volume. We've had above average volume the last few days. It kind of got us going. And once we kind of broke through there, just as when it broke down over here, we see some green candles working in there to work its way back up. So we'll see how that goes. We'll take a look at that breadth really index. The percentage of stocks that are above their 200-day average, was been low. I mean, it's been very low, and now it's working its way back up to where we were back in February when we went through kind of an up phase. But everybody was participating. And this one, the markets have gone up, but not everybody's been participating. This is looking a little bit more like you would expect, but I would still think that this thing, if it really gets going, is the number of stocks above the 200-day average will probably be 80, 85, 90%, somewhere in there would be my expectation. So we got some ways to go, but we made some progress, some gap ups here that are happening in the market. And this obviously then is supported by the IWM, the Russell 2000 ETF that shows that, more stocks are starting to rise. Now, the thing I like about where this sits now as an investor and a trader is 244. Is the all-time high. It's got a lot of room to move up, where a lot of these other ones, like the Dow Jones, its all-time high is what, 37,000. So it's within what, 8% of the all-time high. We got the SPYs. It's still got some work to do. Let's get it on weekly so we can see. Yeah, I mean, still 480. That's what, 12, 13% all the way up. Let's do a quick measure just to see from where we are today to here is 11.5%. So, this is the Russell has a lot more room, from where we stand today. We're talking 32%. So to get to all-time highs, and we're already seeing some of the stocks start to recover. Tesla just went past its 200-day moving average. You've got Apple that went beyond its all-time high before, obviously Nvidia that went by above its all-time high. So we're starting to see some cracks in that ceiling, led by what you would expect, some of the high-profile stocks that are out there getting some love from investors. So looking at some of the things that are going to help fuel this, now we've talked about the 10-year Treasury note yield before, and the expectation here is that we could. We're on the weekly. Let's go back to the daily. Reset the chart. Go and fill. We came close, but we still haven't filled this gap up here. We're at 3.89%, a little under 3.9%. It could make another run out there before the expectation to be that begins to roll over, or it might go down to fill this gap long before we start looking at this thing anytime soon. So, we have this gap down here at 2.89, and it might just be a partial fill, and that might be the end of it. So we'll see what the upcoming days are, but I'm still saying it's in the realm of possibility that it could go back up, hit somewhere around 3.89, 3.9%, and then start to roll over. Now, what we don't want to happen, obviously, is for it to break through and then all of a sudden use this pennant as a backstop, to go higher, because that would be ugly. But that's not my expectation, especially since the Fed looks like it may pause. The DXY, again, it might be that it makes another run up here around 105. Before it begins to roll over here. We're still kind of in a downtrend. Maybe it wouldn't be a bad idea to get up here and get a double top and then make its way down, or maybe a quintuple top. It's been in this range a number of times, as you can see, and got rejected from there, and then we used it as support for a while. But so anyway, that's kind of the way things are moving at the moment. Next week will be a huge week, which I'll talk about here coming up. The crude oil still kind of just meandering its way down. I mentioned last week that the expectation is that oil will make its way down to the mid 60s. It's certainly not getting the volume and love like it was back in here, or it's starting to get to lower levels, a little bit above the average. So again, I'm looking for this to continue to fall. We might say that we have a wedge here down here, and maybe, I'd probably start it here, something like that. And then once it breaks its way down into the 60s. Taking a look at the VIX, it is just getting crushed. So we haven't seen this level since way back in February, basically Valentine's of 20, right before everything started to shut down, and then obviously the volatility kicked up once they started shutting people in. Will never happen again. And we already covered the percentage of stocks above the 200-day, and this is a good sign. I'd like to see this make its way up. It moved pretty quickly from 38 to 51%. I'd like to see it, start to get up here around 67% or more over the next, few weeks. But it can happen quick. It didn't take it long to go from here to there. So it could, this could raise rather quickly. Let's take a look at the economic calendar, and we'll start with this week, which was nothing. I mean, there was really not much to report this past week. There was enough bad data, like the PMI came in weaker than expected. We're not quite below the 50.3 where you'd see contraction. But you did see, a fall in the expectation of factory orders was to be 0.8%, was 0.4. Employment now is below 50%, so it's shrinking the services. And then Wednesday, we got a little relief on the mortgage rate. I think that will slowly but surely continue. We might have that little spike up to in the 10-year, which will the mortgage may fly up just a little bit. We also had jobless claims came in a little hotter than expected, which we've been waiting for this thing to start to show some movement in the upper direction above what the consensus is, and I think we're beginning to see that. This all plays into the Fed meeting, but before the Fed meets, and this is next week's economic calendar, we have core inflation. Now they listen to the PCA, but I guarantee if this, we painted a 6 or something like that, they'd be raising interest rates. So the expectation is on the inflation rate, core inflation rate year over year to be 0.4%. They're expecting the inflation rate, core inflation rate month over month, 0.4%. The inflation rate year over year to be 4.1%, and the core inflation rate year over year to be 5.3%. And I'm guessing that will be pretty close. I follow this Federal Reserve Bank of Cleveland. You can see the expectation of 5.34% right here, which is their estimate. But you look ahead to June, right now, that's looking even a little bit better. And I think all of these things are temporary. Are they going to be temporary enough for the markets to hit all-time highs, and the pendulum that I've talked about since I started doing these, where we're kind of in that sweet spot between crushing recession, depression, possibly, and the euphoria associated with a 40-year bull market, as David Hunter has pointed out on a number of occasions. So, we'll see. We come in and, paint a core inflation rate of year over year of 6% or something like that, then all bets are off the table. And what the Fed is going to do, and the markets will tank. Anything around 5.5%, even if it came at 5.6, I don't think it will. I think anything 5.5% or lower will allow the Fed to pause. It may have a little damage associated with the markets, but we come in less than the 5.3 or even at 5.3. I think that'll be win to the markets back, to the markets. And then they, get a 4.9 or something like that paint, which I'm not expecting for the core inflation rate year over year. Then you may see a huge reaction in the markets next week. So we'll just wait and see what that number is on Tuesday. And then Wednesday, we have the PPI comes out, the producer price index, expecting prices to have actually fallen. The core PPI at 0.2%, which probably to me is a little more significant than this. But then we have, obviously, the big thing is going to be the Fed interest rate decision. Expectation is basically 3/4 of the market or the Fed watchers are saying they're going to pause, 25% saying they're going to raise. So we'll know on Wednesday. And then the Chairman Powell of the Fed will come out and he will do his press conference on Wednesday. And that obviously is a market mover because he can say the wrong thing or misplace a verb or a noun or something, and things will go, or an adjective, and it's kind of crazy. Then Thursday we have retail sales, but all of the excitement's going to be obviously Tuesday and Wednesday next year, the big market movers. We've had bad numbers from, we expect to see initial jobless claims continue to kind of move up over the consensus and even from previous periods. And then we get into the New York Empire State Manufacturing Index, which I follow closely. That thing it's been ugly. And then you have the Michigan Consumer Sentiment Survey, and that continues to go down. It already, as I mentioned in a previous episode, we talked about how the sentiment and interest rates are going to be the two things that could lead to deflation, which is David Hunter's expectation. But there's a few other people talking about it now, but he's been talking about it for a long time. And, deflation is basically what you had during the Depression. So we'll see what next week brings. And, those... my expectation is next week is going to be pretty good news. And I think that we can, at least my expectation is, I watch price action as far as the trading goes. But my expectation is I'm kind of looking for the good news to start to come out on Tuesday, or at least benign news at a minimum, and then no interest rate hike. But those things may not happen, and the Feds may hike. I just don't expect it. I think we're looking at the pause, and the pause itself, once it's confirmed, I think will be wind at the back of the markets. And so we'll see what happens next week. That's what I wanted to cover this week. And remember, there is always a better way.